Trump's tariff threats, they're back, and investors everywhere are paying attention. Just this week, President Trump warned of new import tariffs on key trading partners, anywhere from 10% to a jaw-dropping 70%. But here's the twist. Even with all this noise, the U.S. economy is still looking surprisingly strong. Inflation barely budged. The S&P 500 at record highs. So is this just another headline, or is something bigger brewing beneath the surface? Here's what I'm seeing. According to analysts at ING, the real impact of tariffs always lags behind the headlines. Right now, American companies are sitting on mountains of inventory they stockpiled, bracing for tariff hikes. That buffer has kept prices in check for now. But as those stockpiles run out, expect to see inflation start creeping in, likely by the end of summer. History shows it takes about 3 months for tariffs to show up in consumer prices, and this time is no different. That's why I don't expect the Federal Reserve to cut interest rates in September, even if Wall Street's hoping for it. ING thinks the Fed might start easing up in November or December, once we see where inflation really lands. So what does all this mean for your investments? Cautious optimism is key. The U.S. economy looks solid, but growth is already slowing, and the worst effects of these tariffs might still be ahead, especially for the labor market. Keep your eye on inflation numbers and Fed updates as we move through the summer. This story isn't over yet, and for investors, timing could make all the difference.